Hi, everyone. It's so good to be with everyone today. I'm Rhonda Branch. I'm a regional director with National Philanthropic Trust. I'm here with my colleague, Rudy Flesher. And as a regional director, I really feel like it's my role to be your partner when it comes to anything charitable contributions and giving to our donor advised fund. Really help guide those conversations and provide information that helps our clients and our donors meet all their philanthropic goals. And so this is giving season. This is a really exciting time of year for us. This is a really busy time of year for us. And so we really want to make sure we convey some really key important parts of how to think about giving season as we go into this really important time of year.
Thanks, Rhonda. So I'm Rudy Flesher. I am also a regional director here at NPT. I work with advisors in Southern California, Arizona, and New Mexico. Rhonda works in our New York City metro region, and there are even more of us working with advisors in all 50 states. So we are here, as Rhonda said, to serve you in this busy season. Giving season always brings energy and urgency. Advisors are wrapping up financial planning, clients are thinking about taxes, and philanthropy naturally comes into focus. It's the perfect opportunity to help clients align their financial goals with their charitable priorities.
So today we'll look at why the season matters so much, what's different about this year in particular, and how donor advised funds, or DAFs as they're affectionately called, can be a really effective tool for year-end giving. And we'll also walk through some contribution strategies, deadlines, and a few quick reminders for making this given season a success.
Let's start with the big picture, the giving landscape. While clients may connect with causes year-round, the reality is that giving peaks right now at the end of the year. December alone drives about 25% of all nonprofit revenue. It's when generosity and planning naturally come together and when clients turn to their advisors for guidance. Overall, the giving landscape is stable, but the ground rules are changing. Advisors are going to be central in helping donors navigate this new normal. Nonprofits are facing uncertainty, traditional funding sources are shifting, and government support is in flux. Many organizations are relying more than ever on individual donors, and thankfully, many donors are stepping up. At NPT, we're seeing this firsthand. Grant transactions are up 25% this year compared to last, and contributions have increased 29% over the same period. That tells us that donors remain deeply committed to supporting the causes that they care about. At the same time, we're in the midst of a historic generational wealth transfer. Roughly $84 trillion are expected to move from baby boomers to younger generations. These emerging donors are looking for modern, flexible giving tools like donor advised funds that align with how they already manage their finances. A recent Bank of America study really brings this home. Younger donors, ages 21 to 43, are 2 to 3 times more likely to use a structured giving vehicle such as a DAF compared to older donors. So while overall giving is strong, the ways people give and the expectations they bring to those conversations with their advisors are evolving quickly. Layered on top of that, we have new tax policies coming in 2026, and these will reshape how donors and you as their advisors approach charitable planning.
So let's take a closer look at those upcoming tax changes. Starting in 2026, a new universal charitable deduction will be available, $1,000 for individuals and $2,000 for couples who don't itemize. It's important to note that universal deduction won't apply to gifts made to donor advised funds, private foundations, or supporting organizations. For clients who do itemize, two additional provisions will come into play. First, a 0.5% adjusted gross income floor, meaning the first 0.5% of a client's AGI can't be deducted at all. Second, a new limit on the value of itemized deductions for top earners. For those in the 37% tax bracket, that's single filers earning more than about 640,000 and couples earning more than 768,000, the value of their itemized deductions will be reduced by roughly 5.4%. So in plain terms, higher income donors will see a smaller tax benefit for the same charitable gift. Let's look at an example. Imagine a client with $5 million in adjusted gross income who donates $1 million in cash to a nonprofit. Under current rules, because that gift is below 60% of AGI, the entire amount is deductible. At a 37% tax rate, that creates about $370,000 in tax savings. But In 2026, under the new rules, that same gift would produce roughly $29,000 less in tax savings after accounting for the 0.5% AGI floor and the new limit on deduction value. So the takeaway is clear. It may make sense for some donors to accelerate charitable contributions in 2025 to take advantage of today's tax environment.
Let's talk about donor advised funds because they're central to how donors give at year end.
I mean, they really are. DAFs combine simplicity, flexibility, and efficiency. Clients can contribute assets now, take an immediate deduction, and then recommend grants over time to the causes they care about. It's really a win-win. It's tax efficiency now, meaningful impact later.
And the numbers back it up. There's been more than a 600% growth in DAF accounts since 2014. We're now seeing over 1.8 million active DAFs in the US, and gifts to DAFs represent a significantly larger portion of total giving than they did just a decade ago. That growth tells you that donors are looking for modern, manageable ways to give. They want tools that make generosity easy, and DAFs do exactly that.
Now, let's talk about what clients can give because most people think cash, but that's just one option. In reality, the majority of wealth and high net worth portfolios isn't in cash. In fact, only about 15% of assets for wealthy investors are actually liquid. So when clients contribute appreciated stock, restricted shares, private business interests, even cryptocurrency or real estate, they're often able to avoid capital gains tax and deduct the full fair market value. NMPT has a deep experience handling those type of complex assets. It's a real differentiator for advisors working with us. It means they can say yes when a client asks, "Can I give this?" Now that we've talked about the type of assets clients can contribute, let's look what happens once those assets are actually in the DAF. So at MPT, clients can invest DAF assets either in pooled funds or they can choose to have their advisor manage the account level investments, giving you a direct role in aligning investment strategy with your client's philanthropic goals. Because of our independence, we can accommodate investments across a wide range of asset classes: mutual funds, ETFs, alternatives, private investments, venture capital, impact investments, even direct private company investments. We also offer an exceptional level of flexibility. MPT can hold up to 100% in individual securities and up to 99% in alternative or private investments, a level of latitude that is just not common among DAF sponsors. That flexibility really matters to clients. It means they don't have to compromise on how their charitable assets are invested. They can continue to pursue strategies that reflect their values and your expertise.
And when it comes to grant making, that same flexibility applies. We can support grants to any qualified nonprofit, both domestically and internationally. For clients who want to go beyond general support, we can draft custom grant agreements in partnership with the grantee organization. These are ideal for donors who want to define outcomes, ensure accountability, or attach specific conditions to their funding. So, for example, a donor might want to support a research project, but make sure results are published publicly, or fund a program only once certain milestones are met. Our grant agreements can include elements such as benchmarking, where funds are released in phases based on milestones, results and reporting requirements, so the nonprofit provides progress or impact updates, usage restrictions, ensuring the funds go toward a specific program or purpose, naming rights where appropriate for programs or facilities, matching or challenge provisions that encourage additional fundraising, and donor recognition, such as inclusion in reports, digital materials, or signage. These agreements allow donors to stay closely aligned with their intent and values while giving nonprofits a clear framework for execution. Because these arrangements involve additional legal and administrative work, NPT charges a separate fee paid directly from the DAF. But for many clients, especially those making larger or multi-year commitments, the peace of mind and clarity they provide are well worth it. And that's really what this all comes down to, enabling more meaningful, efficient giving. When you help your clients elevate their philanthropy, you're not just doing good, you're building trust, uncovering additional investable assets, and deepening client retention. Philanthropy opens doors to conversations that extend far beyond charitable giving. It becomes part of the client's broader life and legacy planning, and that's where you add the most value.
So now that we've talked about what clients can give and how those gifts can be managed, let's turn to who you should be talking to right now.
I'd start with clients who already give to charity or have mentioned philanthropy, even informally. According to the Bank of America study, about 85% of affluent households give, but only around 40% have a giving strategy. That's where you come in.
That's right. And beyond that, look for clients facing a high income year. Maybe they've sold a business, they've exercised stock options, or received a large bonus. Also, clients who are updating their estate plans or holding highly appreciated assets or concentrated stock positions, those are all signals for a DAF conversation.
The nice thing is, this isn't a cold conversation. It's values based, and you're talking about what matters most to them.
Now, once you've identified those clients, the next step is to think about specific strategies that make sense at year end. So, two of the most common approaches that we've been seeing are bunching and preloading. Bunching is when clients combine several years of giving into one larger DAF contribution. So, take the hypothetical Thompsons, for example. They usually give about $10,000 a year to charity. This year, they decided to contribute $50,000 to their DAF. That allows them to itemize deductions this year and then make grants over the next several years at their own pace. And preloading is similar, but it's often tied to a specific income event, like a business sale, a big bonus, or a retirement. Say hypothetical client Priya is retiring this year and had unusually high earnings. She contributes an additional $100,000 to her DAF while she's still in the higher tax bracket. That sets her up to support her favorite causes well into retirement while taking advantage of this year's deduction. Those are great strategies for aligning giving with timing and tax planning. Rudy, I know you've got a couple of strategies that focus on portfolio efficiency. Can you walk us through those?
Absolutely. Let's look at rebalancing first. Hypothetical client Jane had $200,000 in tech stocks that had doubled in value. She donated $100,000 to her DAF. By doing so, she reduced her concentrated exposure, supported her favorite education nonprofits, avoided capital gains tax, which increased the amount she could give, and received an immediate tax deduction. Donating appreciated securities is a powerful way to align a portfolio with risk tolerance while boosting charitable impact. Next is the swap, or donate and repurchase strategy. Hypothetical client Carlos wanted to support arts nonprofits, but keep a high-performing stock. He donated shares to his staff and immediately repurchased the same stock at market value. He achieved the deduction for his donated shares, avoided capital gains, and reset his cost basis for future growth. This is a tax-smart way to give without reducing exposure to a high-performing investment. These strategies show how giving can be both strategic and portfolio friendly, maximizing impact while keeping financial plans on track.
I mean, exactly. It's about positioning giving not as an afterthought, but as a thoughtful, integrated part of financial planning.
So far, we've talked about strategies like donating complex assets, bunching, and preloading to make giving more efficient, especially at year end. But a DAF isn't just about optimizing tax benefits. It's also about creating a lasting impact that reflects your client's values and their vision for the future. Advisors play a critical role in that process, helping clients balance strategic giving with the flexibility to respond to new opportunities.
That's right. A clear example is what we saw or what we're seeing now with Hurricane Melissa, which has affected communities across Jamaica, Cuba, and Haiti. Many donors who had their charitable plans already in place, supporting education, healthcare, or the arts, want to help immediately. Because their philanthropic funds are already in a DAF, they're able to recommend grants within hours to trusted relief organizations on the ground. And you can help clients budget for this, the unexpected. As their advisor, you can help them find that balance, aligning charitable goals with both immediate priorities and long term objectives.
And for those thinking ahead, DAFs also make legacy planning simple. Clients can name successor advisors or designate charitable beneficiaries, ensuring their philanthropy continues well into the future. Before we wrap up, let's talk logistics because timing is everything at year end. Three keys really stand out for a smooth giving season. First, start early. Don't wait until the week before December 31st. Second, use NPT's online tools to keep everything organized. And third, lean on us. NPT's role is to support you from complex asset acceptance to donor care.
Exactly. So let's cover the practical slide. Deadlines. To receive the 2025 tax credit, MPT must take possession of contributions by December 31st. That means if clients are mailing checks through the Postal Service, they need to be postmarked by the 31st. And if they're using a carrier like FedEx or UPS, MPT must receive those checks by December 31st. And you want to initiate the transfer of assets before key deadlines as well. November 28th for mutual funds, December 19th for crypto, and December 24th for stocks and money wires. And if you're helping clients contribute complex assets like private stock or real estate, please start now. Those gifts can take up to 8 weeks for due diligence and transfer.
For grant recommendations, we recommend submitting them by December 15th to ensure delivery by year end. So basically, the sooner you start the conversation, the smoother everything can go. Advisors who get ahead of these deadlines are providing these clients a real service. And to make managing all of this simple, NPT's advisor dashboard gives you a complete view of your clients' DAFs all in one place. You can see an aggregate view of all client accounts and charitable activity, track pending actions like new account applications or contribution agreements, and drill down into account level details, including balances, investments, and grant history. It's a great tool for staying organized and keeping philanthropy fully integrated into your overall client management.
Exactly. And advisors aren't doing this alone. When you work with MPT, you're not just opening a DAF account, you're gaining a full support team. Our regional directors, folks like myself and Rudy, help provide transaction planning and guidance to help you navigate every step. Our donor relations team is available with extended hours at year end to support both you and your clients' needs. And our marketing resources provide tools to help you engage clients and communicate philanthropic strategies effectively. So, as you head into giving season, here are 3 simple next steps. Number 1, identify clients who could benefit from a DAF. Number 2, start the conversation. Even a light touch can open the door. We have materials to help guide you through these discussions. And number 3, reach out to MPT. We're here to provide the expertise, support, and resources that you'll need.
Thank you so much for joining us today. From all of us at National Philanthropic Trust, we wish you and your clients a joyful, meaningful, and successful giving season.
Happy giving season!
Happy giving season.